Deeming.
Yep.
I think the way I want to enter this camping ground is when someone applies for the age pension, there's two tests. There's an income test, which how much are you generating from investment assets, from working if you're still working, or maybe deeming, but we'll leave that there for now, or the asset test. How much, you might have a commercial factory bay worth $50 million, but it's empty and it's just there because you want to give it to the next generation, but it doesn't produce an income. What test with the income and asset test or the formula, we have a look at the result of plugging both into the system, and is the pension awarded on the least generous or the most generous outcome based on the two tests, and can they both be used?
They both have to be used. So, the way that it works is we look at what your assessable income is, and assessable income is different sources of income are assessed differently. So gross wages versus potential profit from something like an investment property or self-employment.
Oh, I'm just going to jump in there that I forgot to add. When we were talking before with the work test and the income thresholds and the bank and all that, you can't use investment income in that bank.
No. For the work bonus, that's why I've kept it's wages or eligible self-employment. And when I say eligible self-employment, if you're, for whatever reason, maybe tinkling with shares and claiming to be self-employed, might not meet the requirements.
Yes.
Running my shop or running a business, then absolutely meet that requirement. Does not apply to investment income, doesn't apply to any other source of income, compensation income, pensions from overseas. None of those attract the work bonus. It's just wages or eligible self-employment. So yes, thank you for that. You lodge an application for the pension. We look at the total value of your assets. We look at how much assessable income you've got. We then work out whichever one is going to pay you the least rate of pension, and that's the one that you're going to be using. And you've got to be eligible under both tests to be able to get paid. So in your scenario, I may be eligible for the full rate of pension because I've got no income, but no pension because I've got massive assets. Then the pension rate would be zero. And I'd be saying you'd absolutely want to apply for a Commonwealth Seniors Health Card, or how are you surviving? You might need to really look at restructuring whatever it is you're doing. So whichever one pays you the least is the one that we use. You've got to be under both tests in order to be able to get payment. One of the biggest sources of income that people need to understand is this idea of deeming. And deeming is when we take what we call a financial asset. So by financial assets, I'm talking about bank accounts, shares, managed funds, loans that you have made to other people, those excess gifts that we were talking about over the 10,000 to 30,000 over 5 years, most account-based pensions, and superannuation for people who are over age pension age as a pretty standard list. And what we do with those is we add them all together. So we just give the total of what they all are and we come up with a mass figure, and then we apply our deeming rates. So we decree or declare or deem that these investments are generating a fixed rate of return regardless of the interest that you are actually receiving or the drawdown that you are actually taking. And the fixed rate of return at the moment is 0.25% for the first fixed amount, and then 2.25% for everything over that. And the fixed amount is set on whether you are a single person or a member of a couple. And if you're a single person, it's $64,200 at 0.25% for the total balance, and then 2.25 for everything over that. For a member of a couple, it is $106,200.
Now, just while you were talking there, you saw me tapping and crunching. I'll just assume a single person has a $5 million warehouse.
Yep.
And we won't use 50 mil, we'll use 5 million. The deeming rate basically on that first 64,200 and the balance of 4.935, whatever, Centrelink are going to say for the income test, that asset, we're assuming that it generates $111,000 worth of income, the deemed amount, even though it's not, there's no tenant in there and it's just sitting there.
Yeah, so you're wrong in that we would not deem a warehouse. So a warehouse or investment property is not what we would call a deemed financial asset. Everything's complicated.
Yeah, sorry.
The only time, so if I had a $500,000 $5 million bank account, then yes, that's
Yes,
income
sorry.
for that.
Or an equity portfolio.
Yes.
Yes, sorry.
To clarify, we could do it if the warehouse was owned by a self-managed super fund.
Yeah, but then it's a super asset.
Yes,
not
and that's why we would do it, not for an investment property itself. But if I had an investment property or I had a holiday home, so we'll use a holiday home as an example because that's a good one.
$5 million holiday home.
No income coming from it.
Yep.
It is just an asset. It's a non-income generating asset. There'll be no deeming from that. We'll acknowledge that the balance from that one is zero. If I had an investment property, we'll allow for the deductions that most of the things that the ATO takes off, we take off. So your rates, your bills, all the sorts of things that you're charging for the cost of running the accountant's fees, all the things that you're doing to reduce your taxable income. Most of those will also accept to reduce that. So we're looking at the profit from an investment property or a warehouse.
Yeah, and I think it's probably, I'm just not in this enough, but I like to use property without a tenant for examples because it gets people the practical.
Yep.
However, if it was $5 million in cash,
Yes.
at a 4 and whatever % interest, in real money, it would produce $225,000, but Centrelink will deem it as 111. Right. Does that then? So does the real money then tick over and come online as part of the income test, or
Never.
not at all?
Never. Well, I mean, the person wouldn't be eligible because the asset is too high.
Exactly.
But apart from that, so we said that the asset cutoff point for a member of a couple, well, we'll stay with a single person, is $704,000. So if I had total financial assets and then my only assets, and there was $700,000 worth, so I still had some small pension eligibility. Yes, at 4%, that's what, $28,000 worth of income?
Yeah.
4 sevens are 28.
What's the limit? 760, did you say?
The cutoff point for $704,500.
$704,000. 4,500 times 4%. Yeah, 28,180.
Okay, so the deemed interest on that would be nowhere near that figure.
No.
And we would never look at the $28,000. We just won't look at it. A better way to talk about it is your account-based pension. So if $700,000 in an account-based pension with a minimum drawdown of 5%, that's $35,000 worth of income. We're not going to look at $35,000 worth of income. We're going to deem it at our deeming rate. If you chose to draw down more, you chose to draw down 8% because you're within your rights to do that, we're still only going to be deeming it at 2.25% as a maximum.
Now, these rates were changed during COVID and they're
frozen.
They're frozen until 26?
Yeah, that's right. So they were frozen until the 1st of July 2025, but that's been extended now to the 1st of July, or 30th of June, I should say, 2026. Yeah. So it's going to be staying at 0.25% and 2.25% for that period of time. So
pensioners, you're going to make some extra money in the next 12 months?
Well, this is some of the things that I really like about deeming. It's it's a universal leveler is the best way to describe it. So when it comes to looking at my retirement and investing for my retirement, in the past, I would be looking at investment options that could potentially improve the rate of pension that I'm getting. And so I'd invest for the pension. Deeming makes that pretty much pointless because if my bank account plus the cash that I've got hidden in the mattress plus my superannuation plus my share portfolio are all treated by Services Australia exactly the same way, then there's no motivation from a pension perspective to put the money in the bank account or the share portfolio or the super fund into an account-based pension.
Do what you want.
Now you focus on the purpose of the investments themselves, which, as any financial planner should be saying, is your overall motivation. Why would I choose super over a bank account? Why would I choose a share portfolio over an account-based pension? Let's look at the investments and what's good about them and what do they provide and how can they be useful for me, not let's look at what they can mean for my pension. So it's a universal leveler, and I think that's a fantastic aspect.
Yeah.
It also means that I need to tell you about all the time my income changes because we don't care about when your income changes. When you lodge an application for the
unless it's a earned income from work.
Then we absolutely care about it. That's right. Very good. Thank you. So when you lodge an application for the pension, you're going to notice that we don't ask for the interest rate on your term deposits.
No, because you don't care.
We don't care. We deem it at our 0.25% and our 2.25%. So we don't look at those individual details. So your reporting from that perspective is significantly easier.
Well, these rates, they were halved at COVID, weren't they?
They've flown up and down. They've grown and they've shrunk. It's when the financial crisis hit. Because normally, if they're going to change, they'll change on the 20th of March and 20th of September.
Yeah,
that's just a custom. It's not a requirement. And when the global financial crisis hit and everything was falling down, the deeming rates actually were dropping almost on a monthly basis for a while there.
Yeah,
and then they started going up again when the market's gone up. The market has been going up. Interest rates have been improving, but the deeming rates haven't changed. Again, that's just the rules that both the governments have put in place.
Okay, an interesting point here. We need to update Your Majesty within 14 days of changes. What about if our investments increase or decrease? Is there an amount that we need to tell you?
So with financial assets, we're meant to be told if your financial assets increase by go up by $2,000 or more. You don't really have to tell us if they go down, but if you're a part-rate pensioner, you may want to tell us if they go down.
Because that could increase your
the rate of pension. Now, there is a big proviso on that one. That doesn't include shares. So not shares owned through a self-managed super fund, but shares that are owned directly.
Or a retail super fund.
Yeah, any super funds.
Yeah, super environment.
Sorry, yes, any shares that are you're right. Any shares that are in a superannuation environment, they're covered under the balance of the superannuation fund. Shares that are owned directly are a different story. So Services Australia acknowledges the volatility of shares, and they acknowledge that, if I was supposed to tell you changes in the value of my shares, when do I tell you? At what point did they go up?
Thursday morning?
Or 20 minutes from now when they've changed again. So what we do is that we actually, once you're on the payment, we set the value of your shares on the 20th of March and the 20th of September. And we basically say that's what we're going to accept the value of your shares are going to be for that 6-month period, and we will revalue them on the 20th of March and 20th of September. So you don't have to tell us of changes of the value of your shares. We will take care of that automatically. You can choose to tell us again if the shares reduce in value, but it's really important to say that we don't just revalue one, we revalue all. So if one of your shares have fallen in value but the other 4 have gone up, you might not want to actually have that conversation because you could be in a worse position because they've gone down. You don't have to tell us about changes of the value. You do have to tell us about change in the number of your shares. So buying any, selling any, getting some given to you through a dividend reinvestment scheme, they are all what we would call a notifiable event. You need to tell us within 14 days of that happening. So unless you're buying and selling or unless you've been given some, you can just sit and leave your shares go and we'll take care of it. The other one is property. So with investment properties or holiday homes, we first of all don't expect you to value that. We don't want you to go out and pay for a valuation. We take care of that valuation ourselves, set it from the date that your pension is granted. We will then
I challenge the valuation if I think?
Absolutely, you can. So it's an independent valuation. We've got a third party that does it, but
that would be akin to just a desktop val that brokers use and all that stuff.
Yes.
Yeah.
They will inspect the property if you challenge the value of the property. So if they don't know it was Auntie Mavis's old place and she hasn't looked after it for ages, and you risk going through.
It's
the
actually
floor.
not worth $2 million. It's worth about $100,000 because it's a
because
dump.
have you seen this place? Yeah. I mean, you will give us on the application details of the property to give us an idea of why it might be not worth that. But if you think we're right off base, then you can absolutely challenge that. But assuming that we're pretty close, on the anniversary of you claiming payments, we will then automatically revalue that property. So again, my property was worth $400,000. It's now worth $420,000. At what date did that $20,000 increase happen? There's no date. So unless I've actively gone in and put money into it to cause some changes, I've put a swimming pool in, we've done something significant that's increased the value, there's nothing to tell. Services Australia will just revalue the property on the anniversary of you applying for payments. So again, yes, we're talking about changes of your assets, property and shares. We will take care of automatically unless you're actively doing something in them. The other one, just as an aside, that people will often make mistakes on is valuing your household contents and personal effects and depreciating your car. We don't depreciate.
Okay.
So if the car is it was worth $20,000 when you bought it. You turn the ignition, it's now worth $15,000 because that's just the way the market works. When you're reporting the pension, the value of the car is $15,000, not the $20,000 it's insured for. It's whatever you get on the market. If 2 years later it's now worth 12, you need to tell us it's now worth 12.
Is there a threshold that I can have up to X personal assets that isn't part of the asset test?
No, it'll all be part of the assets test. It just means that not very much. And that's the other point. When it comes to household contents and personal effects, we are again looking at what you would get if you put it on the market. So realistically, it's garage sale value.
Yeah.
Life on the lawn sort of concept. My entire CD collection is worth $10.
You wish.
Yeah, that's right. My 1970 Mission Brown Wickerworks couch is worth $15 if I'm lucky. It's that sort of value.
Yeah.
But we don't want you to put a lot of thought into that. I had a gentleman who came once and he had 4 or 5 pages where he had actually gone through and valued everything in his house as realistically as he could.
Well, you get that with a retired engineer, I guess.
As I said, it's one of the most beautiful and pointless documents I've ever seen because he could have just said it's $5,000 and we would have gone, fine, we accept that.
Knock yourself out.
We won't challenge it, but sometimes we will ask the question because people overvalue.
Yeah, it's just a please explain.
Yeah, I actually had a customer who wasn't eligible because they said their household contents and personal effects they were close under their other assets, and the home contents pushed them over because they said it was $70,000 because that's what it was insured for. I said, so if you actually tried to sell that today, what do you reckon you get? She said, $6 if I'm lucky. That's the figure that we want. You're now under the cutoff point. You can now apply for a payment. Not because she did anything wrong, but she just didn't accurately value.
Yeah, overcooked it.
Yeah, what the household contents was worth.
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.